Welcome to Analyzing Finance with Nick. We've done the iceberg of finance, economics, and wealth management, and now we're going to do our next iceberg, which is the iceberg of options and volatility. Why are we doing this one? One, I think this is something a lot of people don't know that much about. I have a pretty strong expertise. I worked at one of the largest options market making hedge funds for 3 years as a research analyst. And I do a lot of options related work for my clients at my current wealth management firm that I am a partner at. So I figured I would kind of share my expertise and kind of go down the layers of the iceberg in the world of the derivatives market. First iceberg, as a disclosure, there's nothing on here as investment advice. Please do your own investment research or retain an investment advisor. I'm not going to answer any specific trading related questions in these videos. So if you have those kind of questions, instead of the comments, I recommend just contacting me directly, either through email or my consultation form. Now, without further ado, let's get started with layer one. Layer one, derivatives. A derivative is really just simply a security or financial instrument that moves based off of an underlying asset. So an option moves based on the underlying stock. A futures moves based on the underlying price of the commodity or index or currency it represents. And credit derivatives move based on the underlying credit portfolio that they're collateralized by. So that's simply what it's a derivative. It's similar like a derivative in calculus. A derivative is the slope of the line, whereas the derivative in finance is something that moves as a derivative of an underlying asset. And there are two main kind of derivatives that I'm basically going to talk about in level one. One are futures contracts, which futures contracts are derivatives that you can buy on margin, and they represent usually commodities, but they can be indexes or currencies as well. And they mark to market daily, and they represent delivery of a certain item, whether it's a commodity or a currency. And if the index, they usually just pay out cash value at a fixed time. So you can buy futures, say, for a contract ending in March or in April or June or December, and you will have to take delivery of the underlying asset whenever that future expires. And they have often limit prices that they can move limit up or down based on activity. And if you don't sell the future by the end, you are stuck taking delivery of the product. This was used mainly for farmers historically to hedge. And that's why the futures market in the US originated in Chicago, because that was the westernmost point that a lot of farmers can ship their goods out into the Atlantic Ocean through the canal system, connecting the Great Lakes to either New York City or the St. Lawrence Seaway. And then Chicago also could connect indirectly through the canal system through the Mississippi River to go out through New Orleans as well. So that's what futures are. Options are a little bit different. Options, instead of having a fixed delivery of a certain good, options have a fixed option as the option, where a future you have to take delivery of the good. An option gives you a choice to take a delivery of the good at the same for a fixed price for a given time period of time. So say, for example, I want to buy an option on a stock. Like I want to buy a call option, which puts and calls are the terminology for buying. A put is a right to sell something at a future fixed price for a future time. And a call is the opposite. It's the right to buy something at a fixed price for a future time. So if you want to make a bullish position, you buy calls. And if you want a bearish option, you buy puts. And so say, for example, the stock's $100 and you buy a call. If the stock rallies to 150 by the time your call expires 3 months from now, your option is worth $50. If the stock is trading at 99, your option is worth $0. If the option is trading at $4, the option's worth $4, but you take a $1 loss because, let's say in the example, you paid $5 for the option. And I'm going to get into details of why options are priced the way they are later in this iceberg, but that's essentially what an option is. It's kind of like buying an insurance contract on the item that you want, which is why options oftentimes, as I mentioned in the iceberg wealth management, are used for hedging. You can also sell options as well as buy them. So if you sell an option, you have to be willing to provide the item at the price that the option buyer buys. So it's called writing an option. It's kind of like writing an insurance policy. You're, instead of insurance underwriter, you get to be the underwriter of the underlying asset that the option buyer is making a bet on. And options don't have to be on stocks exclusively. You can have currency options, and you can have embedded bond options, and you could also have futures options. Options are a lot more flexible than the seeds of the public eye. Layer number 2 is the VIX. So I'm just going to talk about volatility in general. Volatility is like the average standard deviation that the market moves in a given point, or if it's realized what it has done. If it's implied, which I'm going to get into later, it means that's what the market's expecting to. But volatility is just the movement of the underlying asset up or down. And volatility is really often as a proxy for risk, even though I don't think that's a perfect connection. I don't think risk and volatility are the same. And VIX is the measurement of S&P 500 volatility. The historic level of the VIX is about 15, which implies a little bit less than a 1% move per day is the expected move on the S&P. Like the way you calculate this is like you divide the expected movement by the trading, like the number of trading days, and it gives like a calculation of what they expect to move on a certain day. So the lower the vol, the less the market is expected to move. The higher the vol, the more fear is in the market, and people expect the market to move more. And usually volatility is correlated to fear. So bear markets tend to have higher levels of implied and realized volatility, whereas more calmer markets and bull markets historically tend to have less volatility, unless if there's like a retail speculative mania that kind of shifts it more towards the other way. But yeah, there's basically, when VIX is at certain levels, it's more attractive to be an option buyer. When it's at certain levels, it's more attractive to be an option seller. And when it's in between, then it may be better just to trade the underlying. There are traders who just solely trade VIX as well to arbitrage it. And it's like VIX is not a security. The way that people can invest in VIX, or invest is not really the right word, trade VIX is really through futures contracts. And given how much like volatility tends to mean revert, the VIX later date contracts often do not really line up well with the front month. And the front month is so short term that if you're trying to make a longer bet on volatility at the current level of the VIX, it's rather difficult to do. But that is a wrap up of what really VIX is. It's just the index for volatility on the S&P 500. And there's different kinds of VIXs for other securities. Like there's MOVE, which is effectively the VIX for bonds. There's like the QVIX, which is like NASDAQ VIX. They have VIX for a lot of other sectors or countries' indices too. So you can kind of get an idea of what vol is for these asset markets. And even on most brokerage platforms that specialize in options, such as Thinkorswim, you can get like volatility for individual stocks too, even if it doesn't have like a formal term for it like VIX. The next is credit default swaps. Credit default swaps are a credit type derivative, which you can buy to hedge the failure of a borrower to make payments. So the credit default swap is priced essentially on the market's probability that a creditor will default. And by the definition of default is that they miss a coupon payment, whether principal or interest. And if they miss a payment, the ISDA, which is like the authority of derivatives, particularly credit derivatives like CDS, will decide if it's officially a default. There's some controversy around this surrounding the Greek debt crisis, but I don't really have time to get into that. But the point being is, this is what you buy to hedge yourself in the event of a failure of bonds creditors not being able to make credit on publicly traded bonds. AIG in 2008 got in a lot of trouble for selling a lot of these things at way too low of a price. And then 2008 happened, and a lot of these credit default swaps triggered, and AIG didn't have the money to because of the serial correlation of a lot of these defaults. And it led to a severe counterparty risk issue, which is actually a term later in this layer of the iceberg. But however, if it's a more isolated incident, like a single company just badly managed and they default, you're likely to be made whole on credit default swaps. And even just like this slightest odds change, maybe it's like from a 1% odds of something going bankrupt and missing a payment to a 10% odds of the same event happening, causes big jumps in the credit default swap. So speculators can make money betting on the CDS. They're not very accessible to retail investors. You usually got to be a pretty large institutional investor or a hedge fund to really be able to buy CDS. So it's not going to be really easy available on your Robinhood account, but that's a way it's kind of like a way to effectively buy a put on a bond in a way, or just bet on the failure of credit products. And structured products are kind of another derivative where you basically pool a bunch of loans or bonds and put them in a single security. And they are tranched basically, which is sorted into tiers based on which ones are the highest likely to pay back versus the lowest likely to pay back. And you can buy different tiers on the tranche depending on how much risk you want to take. And the top of the tiers, the safest stuff, those almost always pay out. And then as you get progressively lower, the default rates get higher and therefore the risk. The main thing of 08 was a problem with this is that they rated these whole things AAA or max safety, even though the lower tiers were definitely not that safe. But since they were pooled with the same stuff as the higher tiers, it allowed for some issues of misrepresentation. But structured products are a way to invest in certain types of credit, which are not really safe to lend on an individual level, but tend to be safe for pooling. Example would be MBS, mortgage-backed securities, or credit card securities. You wouldn't really want to buy the credit card debt of a single credit card borrower. That's very high risk. That's why interest rates are so high on credit cards. But if you bought a pool of them, thousands, if not tens of thousands of credit card borrowers, the default rate becomes a lot more predictable because there's a certain amount who are not going to make whole. And so and also these tend to be over collateralized so that there's a lot more cash and other collateral to make up for the fact that credit cards are riskier to borrow. So that's why the interest rate on a credit card security is not as high as it would be for the credit card payer, because they put in more collateral, whether it's additional cash or additional loans, credit card loans, than what the lenders owed at the end. And this is the same for mortgage backs or CLOs, which are corporate loans, or a variety of other things that could be put into these structured products. So that's essentially what structured products are. They're ways to pool credit risk so you can get a more stable and safer return profile and historically more riskier assets. Counterparty risk is the idea that if you're a derivatives trader, you have to be concerned of the solvency of the other side of the trade, because most derivatives, whether futures or options, are zero-sum games. For every buyer, there's a seller. For every long, there's a short. And so the brokers tend not to go broke because they're just the clearinghouse. But there isn't always another side. And the risk is that the guy on the other side is not capitalized enough to pay back the winner of the trade. Then how are you going to get your money when you win? This was the problem with the CDSs. A lot of these banks, insurance companies were selling these CDSs and they didn't have the cash to pay out. And so there's the counterparty risk even if you don't get what you want, which is why generally a lot of investors don't bet on the end of the world or the zero hedge scenario, because great, you might have won. Let's say the stock market collapses 90% and we go back to the Stone Age. Who's the counterparty who's going to be able to pay you for your puts? There's nobody, because if things are that bad and the banking system goes kaput, there won't be a counterparty who's able to actually honor their side of the deal. And that's what you have to look at. Most exchange listed stuff is fairly safe from this because there's margin calls and other tools that will force liquidation of the other side before they get to the point that the counterparty can't pay. But for more over-the-counter stuff and derivatives, this is a more real risk. And you have to look at who your counterparty is and who do you trust them. And this was a problem with 08 because people didn't know who actually could make good on their counterparties. And so it basically froze the market. Zero-sum games, the last term, Options are a zero-sum game. As I mentioned before, every buyer, there is a seller. For every winner, there is a loser. So even though like people who try to sell options or covered calls or cash secured puts or things like that as a strategy in itself, they say that they'll win most of the time. And like, yeah, statistically they'll win about 70 to 72% of the time, depending on what source you see. But in the event they're wrong, the amount they lose is over 3 times what they often are risking. So it ends up being a wash. Like most of the time, the vol sellers do win, but when the buyers win, they win by the same multiple that would cause the trades essentially to even out. So if you're really going to play in the derivatives world, you need to really have some sort of edge if you want to gain real alpha. Otherwise, you're likely going to get canceled out because, I mean, not everybody can win. It's not like stocks where they have more positive expected value. Like assuming not every long in the stock market is countered by a short seller. But for options and for futures, that is definitely the case. Now we are at level 3. And the next thing we're going to be talking about is Nicholas Nassim Taleb. Taleb is famous for writing his series about books such as The Black Swan and Anti-Fragile, where he discusses just the nature of risk in society and of black swans and other kind of things that should be obvious or not obvious. And even though that's what he's probably most famous for as an intellectual, he built his career as an options trader. And he wrote a book called Dynamic Hedging, which is kind of the Bible about how to trade from a volatility perspective. It is probably one of the most difficult books I've ever read in terms of just general understanding, and I had to reread it several times to kind of understand the concepts. So I'm not going to really bother try to explain the content of dynamic hedging other than the fact that you can dynamically hedge options by, as the option price moves, to lock in the gains from the change in implied volatility, you can buy or sell the underlying to delta hedge. So you get rid of the directional bias as the stock moves one way or the other to really capture the change in the vega or the volatility. But I'm not going to really get into it more than that. Is Nassim Nicholas and his role in finance. He is also part of at least as a strategic advisor of the most famous tail hedging fund, which is our next concept, Universa, which was started by Mark Spitznagel. And tail hedging is the idea that you buy way out of the money options, usually downside options, because people aren't concerned about the right tail when things go good. Because when things are going way better than expected, your normal investments will do just fine. Most tail hedging concerns are more for the left tail. So when things are going bad, like COVID, for example, was when Universa made like tens of thousands of % in a month because their very low strike options actually hit. But that may only works like once every 10 to 15 years, if even that often. And so like a tail hedging strategy is kind of the opposite of like the vol strategies, selling strategies I'd like to criticize, where you're going to lose money most years or break even at best with these tail hedging strategies. But then the 1 year where things really just kind of hit the fan, you really get paid on those things. And because tail hedging is kind of popular and a lot of people are concerned about it, the deep out of the money puts often tend to have higher vol than they would otherwise. And that's why you have a somewhat downward skew bias in most options markets, unless if the animal spirits are excessively bullish. And usually when those are the case, those are the opportunities to buy skew. But that's a little bit about tail hedging. Sheldon Natenberg is the next term. He wrote like the other kind of Bible of options, but his is more just a primer of how options work and all the types of spreads and strategies and things you can do. Like it's the actual beginner's book. So if you really want to learn about options, like I recommend reading Natenberg on options. Like his book is handed out to basically everybody on trading desks, including myself. Market makers. There are 2 types of participants in the markets. There are market takers and market makers. Market takers are people who are trying to take a directional bet or a position, whereas a market maker is an individual or a firm who is providing liquidity for you to make that bet. So think of you as the market taker as the gambler and the market maker as the house. in this deal for the casino. Like the market maker, usually in options, it works really well because a lot of the market takers are using options for directional or hedging purposes. They're not purely related to their volatility value. Whereas the market maker is trying to gain an edge through trade, being directionally agnostic and making a bet on implied volatility. So they will delta hedge position with the equal amount of stock needed to do that, and then just hope that the realized fall is not either higher if they're selling it or lower if they're buying it than what the market expects at that moment. And they do this they don't do it right at the market rate. They do a little bit above or below, and that is called an edge. And that's the price of you paying for them to provide you liquidity, because if there isn't that, there's really no incentive for liquidity providers to provide any liquidity.